Oil prices hit $36.72 a barrel today. Brent crude $39.48. I'm loving what I'm seeing right now, but we're still not out of the woods yet, guys. At $40 oil, most oil companies cannot prosper right now. And I'm going to go into more of that in detail. And bottom line, we got an OPEC meeting coming up. I want to talk about that. I want to talk about what's happening in the shale industry and where I think oil prices are going. I'm Sean Pruitt, president of Kingdom Exploration. I've been in this business and investing in oil for the last 25 years. If you like my channel, please subscribe. If you want to learn more about oil and gas, look at my description below and fill out the request form. Now, as you can see here behind me is a chart of U.S. oil output. Back in February 2020, we were producing 13,100,000 barrels a day, and we've dropped down to 11,400,000 in May. In a few months, we've lost almost 2 million barrels a day. And to grow that 2 million barrels a day, it took 2 years of shale development. 2 years. 2 years of one of the biggest economies of America, which we have the greatest GDP in the world, is gone. 2 years of hard work, 2 years of spending money. It's gone. And that's unbelievable. 2 million barrels a day. Unbelievable. They put so much effort, so much backbreaking work to build that up, and it's gone. And so this is people's thought process. Well, Sean, it's going to come back. When oil prices come back, they're just going to turn the spigots back on. Well, that's what they want you to believe. Right now, they are trying to take this egg off their face. They're wanting you to believe. And when I say them, I'm talking about these big shale executives like Chevron, Texaco, British Petroleum, all these major shale companies in the oil patch. They really want you to believe and point the finger at COVID-19, point the finger at this pandemic and the reduction of oil demand. Well, that's half true. Okay. But the problem with shale oil and gas is that it takes a technology in order to extract oil from it. It's too tight of a formation. Okay. A conventional oil sand, for instance, you can develop that well without spending millions of dollars on a frack. And because of that, that's why the longevity of a conventional well is much greater. The decline curve is lower. A decline curve means that if the well starts here and then it will decline in production. So if we start at 1,000 barrels a day, it might drop down to 500 in 6 months. Okay. As where a shale well, the decline curve is like much faster. Okay. And so 1,000 barrel a day shale well might drop down to 80 barrels a day in a few months. Okay. So what you're seeing right now, this curve right here, is not just because they're shutting in wells. That's a very small portion of it. The biggest part of the fact is that they're not drilling any more shale. The rigs are falling off the market right now. U.S. oil rig count dips to lowest on record. U.S. crude production fell for the second straight month as the number of rigs fell to its lowest record level during the week ending May 15th, according to government data released Wednesday. So the rig counts are dropping. If you don't have rigs on the field drilling oil, that means they're not developing. And if they're not developing shale, you're going to see a major reduction in output because shale oil has a fast decline and they want to blame it on shutting in wells. But at the end of the day, the reason why it seemed like we got vast amounts of oil from shale was quite simply we were spending so much easily accessible money, billions of dollars, billions of free money to develop a play that it wasn't economically feasible. It would have made more sense not to develop the play than to go out and drill for some shale oil. Okay. So bottom line, this curve has to do with a decline curve. The shale wells are dropping in output, and it was very easy to hide because they were developing so much shale oil. For every decline, they had 10 wells, brand new wells they're putting online that covered up. If you look at these numbers from 2012 all the way to February 2020, you think, wow, shale is the greatest oil and gas discovery the world has ever seen. But if you're spending more money to get these numbers than you're actually selling the oil for, then it doesn't seem like a very smart play. So, could the worst be over for America's oil frackers? America's oil producers have slashed output and cut $400 billion from capital spending budgets. The pace of drilling is down more than 80% from the peak of the great America oil boom that saw output more than double in the less than a decade. To start, Americans are driving more. Corona lockdowns had gutted gasoline consumption by mid-April. Now, according to Deutsche Bank numbers, we're only driving 30% less than before. So the numbers aren't as bad as what people thought, okay? And so 30% less driving and we were on lockdown isn't near as bad as the numbers that they were saying. Likewise, worldwide petroleum demand appears to have bottomed out in May at 79 million. Okay. What everybody was saying was we lost 30% of our demand, 30 million barrels a day. And that simply wasn't true. It was more like 20%. 20 million barrels a day was taken off, and that number is going to increase. Okay. So according to Rystad, the energy consultancy, which sees June demand creeping up to 84 million barrels a day, still a far cry from the 99.5 million rate at the end of 2019. But it's progress. Meanwhile, America's oil drillers are helping to alleviate the oversupply by mothballing rigs with unprecedented urgency. The Baker Hughes rig count is down nearly 500 this year to 289. That helps knock 1.6 million barrels. So bottom line, the oil and gas industry is shrinking very quickly, and we're not out of the woods. It's only going to get worse here. Now, there's some good news. Oil rises with producers favoring 1 month cuts extension. Oil rose past 36 a barrel as investors eyed a potential of extension of record production curbs by OPEC Plus, while physical markets showed renewed signs of tightness. So, bottom line, OPEC is Saudi Arabia, and it's the surrounding countries surrounding it. And what they do, they get together and they look at the numbers. They look all the data. They look at world output and demand, and they decide how much to cut back to stabilize the oil and gas market. But their agenda, the agenda behind every meeting, is how can we beat shale? If you look back not too long ago, Russia and Saudi Arabia decided to have an oil price war. An oil price war where they pumped so much oil into the market, it caused us to get to the point of negative oil prices. On top of that, we had COVID-19 and we had many other things happening into the markets. So it was the perfect storm of the destruction of oil prices, thus causing the destruction of oil production. Okay. And so the shale industry is being taken out by OPEC Plus. OPEC and Russia, Saudi Arabia, their plan is to destroy the U.S. American oil and gas industry. But I don't blame them. When oil prices were $100 a barrel back in 2008, we were at $140 a barrel, okay, around this time right here. So we were producing about 5 million barrels a day. That's America. We were pumping out 5 million barrels a day because oil prices were well over $100 a barrel. But once we started really flooding the market with oil, with shale oil, because of that amazing discovery, oil prices started dropping tremendously, causing Russia and Saudi Arabia to lose their stronghold and their power in the oil and gas industry. And so bottom line, their focus and their agenda is to do whatever they can to destroy the oil and gas industry. Now, the bottom line for shale, The minimum oil prices need to be in order for them to even break even is $60 a barrel. Now, shale oil and gas, you have to develop in a very premium location in order to spend $20 million, to justify spending $10 to $20 million on a shale oil and gas well to be really profitable at these prices. Well, all the premium leases are gone. They spent billions and billions of dollars developing shale as fast as they could. All those premium leases are gone. And without those premium leases, it is not economically feasible, even if oil prices hit $60 a barrel. Okay. Now at 30 something dollars a barrel, they are losing their butts. So the whole goal of Russia and Saudi Arabia and OPEC is to keep oil prices at a price to where the shale industry will crumble and at a price to where Russia and Saudi Arabia can continue to maintain their countries to stay above water. So it's not enough money for Russia. It's not enough money for Saudi Arabia, but they are far in much greater position than shale will ever be. Shale, and here's the other thing about shale oil and gas. Everybody thinks, oh, well, when oil prices come back to $70 a barrel, shale oil and gas will start thriving again. No. Who in their right mind is going to invest into an industry where the truth came out over the last 10 years? During a time of when oil prices were $100 a barrel, in the last 5 years, they averaged 60. They took 35 shale oil and gas companies, some of the biggest ones. They calculated how much money they spent on the development of shale and how much returns, and they lost $84 billion. Who's going to invest in an oil and gas industry that you need a minimum of $60 a barrel to survive? Who's going to do that? And not only that, the shale industry, each well that they develop becomes less and less productive, less successful. So even if oil prices come back in a big way, the shale industry is still needing, and they're in dire straits of serious they're undercapitalized. They're not cutting back on development because it's a smart move. Oh, because we don't want to add to the oil glut. No, they don't have the capital to do it anymore. Banks are cutting them off. They are in debt. The debt is tremendous. And so they're not going to be able to survive it. And so the other step would be to go offshore. Okay. The offshore industry is simply drilling in the ocean. Okay. But the problem with that, at current prices, even offshore is not profitable right now. I want to read this 3 reasons oil prices are bouncing back. The first is that the U.S. oil rig count is falling at the fastest rate on record. From March 13th, the rig count was cut in half in just over 6 weeks and is now down 65% since that date. So the oil and gas industry is shrinking very quickly, okay? The only comparable period was when oil prices crashed in 2014, but it took nearly 6 months at that time for the rig count to be halved. The falling rig count is an indicator that future oil production in the U.S. may be lower than it otherwise would have been. However, the price crash has also had a rapid impact on current U.S. oil production. At the end of March, the U.S. was still producing 13 million barrels a day. By mid-May, that had dropped more than 10% to 11.5 million. By comparison, following the 2014 oil price crash, oil production only fell by 1.1 million barrels a day, and that took a year to happen. And what took them a year, we were able to get it done in 1.5 months. In 3 months, we lost almost 2 million. Okay. It took them a year to lose 1.1 million barrels a day. So this is a very extreme situation. And where's the benefits, Sean? Well, here's the thing. Okay. Conventional oil and gas is profitable at current prices. If you're drilling a well at $500,000 to $600,000, you are profitable at these prices. I mean, this is the way it was back in the 80s, 90s, and early 2000. Back in 94, when I was developing oil and gas wells in North Texas, oil prices they hit $50 a barrel for the very first time, and we were all very excited about it. Okay? We thought we that would be like today, oil prices going up to $300 a barrel. We were ecstatic. Okay. So what's happening right now? The shale oil and gas industry is getting pummeled right now. It's going to fall even more because of the oil decline curves for shale oil and gas, because that tight porosity needs another frac. It cannot maintain the effects of the frac. So the decline curve is massive. So you're seeing a major drop in oil output. The banks have cut off shale. The development of shale has come to a halt, a screeching halt. And even when oil prices come back, shale isn't coming back the way people assume. They just think, oh, Chevron and British Petroleum and all these big oil companies, I'm waiting for them to come back because I'm going to make a lot of money because I'm buying low. Look, guys, shale oil and gas was their only option, and it failed. And they thought over the last 10 years of developing shale oil and gas, in their mind, they thought, we're going to produce this until a new technology comes out or until we have a new discovery. Well, that's what they said about offshore oil back in 2006. And so now all the premium places have been taken. The risk is too high, and it's very expensive to develop in the ocean. Well, the benefit of shale was, you're onshore. Okay. You don't have to deal with the enormous amount of capital that takes to build a big old rig out in the middle of the ocean. You don't have the risk of life like you would on a shale oil well. It's a much easier to develop on the surface. Getting all the equipment out there is much faster and it's much easier. You don't have to build a massive platform in the middle of the ocean. And so the shale oil and gas industry blew up. Instead of spending billions in the ocean, they spent billions onshore. But the problem is that this development turned out to be a massive Ponzi scheme. They lost $85 billion in a 10-year period out of 35 companies. They would have been better off taking that money and investing it into a bond. They lost their butts. So did the banks. So did everybody else. And so they're pulling out in a massive way. And right now they want you to believe that the shale oil and gas industry is getting hit because of low oil prices, because of COVID-19. No, it's because you are declining, because it cannot maintain this output, and you don't have any money to develop anymore. So what's our only option? Conventional oil. The big majors aren't going after conventional because there's not enough room to spend $10 billion. And so guys like the small guys like me can go out and find a lease and drill 10 wells at $600,000 a pop and make a tremendous amount of money at current prices. And now's the time, because if wells are much cheaper to develop, lease acquisitions are much cheaper. And so we're developing now, we're profiting at these current prices. And then on top of that, I truly believe once the shale industry, while Saudi Arabia and Russia is going toe to toe with the shale industry, once the shale industry takes a big enough hit, we're going to see oil prices come back in a major way. Is that going to take 6 months in a year? I don't know. But I truly believe that it's happening. It's shrinking. If you like these videos, please subscribe. I'm Sean Pruitt. If you'd like to talk to me, look at my description. Find my contact information by requesting information. I'd love to chat with you. Thanks.